Hi, and welcome to Chapter 8. This chapter is on internal controls and bank reconciliations. So let's talk about Sarbanes-Oxley Act. So the Sarbanes-Oxley Act only applies to companies whose stock is publicly traded on public exchanges. So companies like Walmart, Apple, Shopify, all these companies that we can buy their stock on a public exchange are called publicly traded companies. So who does it not apply to? Private companies. So a company like CSpire is not publicly traded. So the Sarbanes-Oxley Act applies to these publicly traded companies, and its purpose is to foster public confidence and trust in the financial reporting of companies. So it's easiest to see why this came about. So before we had Sarbanes-Oxley, just before it, we had several companies, large companies, that committed fraud. They lied on their financial statements. WorldCom did, Enron did. Both of these companies are now bankrupt and gone because of their fraud. And so what happened then was people didn't trust financial reporting. And that is a problem because then people don't want to invest money into these companies. So Sarbanes-Oxley was enacted, and it gave additional assurances to investors, and it made new rules. And after the passage of Sarbanes-Oxley, we started to get back the public confidence. People had more effective internal controls, and so there would be less fraud and theft, so the investors and stockholders and creditors could trust the financial statements more. Okay. So Sarbanes-Oxley requires companies and their independent accountants to report on the effectiveness of the company's internal controls. So not only do they test the items in the financial statement to give some assurance that they're properly recorded, they also have to audit the internal controls. So internal controls of a company are something that are set up to try to prevent fraud and also try to prevent mistakes. So an internal control, one of the main ones that are used are cash registers. But there are others. Some are that you've got to have a separation of duties. You don't want to have the same person handle cash that records cash. Now we'll talk about it in a few minutes, but some companies are so small that it wouldn't make sense to have multiple people. But in a large company, then the cost out is worth having somebody extra for that internal control. But Sarbanes-Oxley said that the auditors have to audit these internal controls. Not only do they have to make sure that they are in place, they have to make sure that all the employees understand them and are using them properly. An example would be if you've got a camera looking at a cash register, that's an internal control. But if somebody moves that camera and it's no longer looking at the right person, well, you've got the internal control, but it's not doing its job. So now the auditors have to look at all the internal controls and make sure they're being used properly. All right, these reports are required to be filed with the company's annual 10-K report with the Securities and Exchange Commission. All right, so this is an example of eBay's report of compliance with Sarbanes-Oxley. So I'm not going to read it all, but this is just an example of what would be in the report. So you can pause it and read it and see what that would look like. All right, so internal control, what are the objectives? First of all, we want to safeguard the assets. We do that by using a safe. We do that by using cash registers. We do that by locking extra inventory and not giving everybody access to that extra inventory, so safeguarding assets. Accurate information. So we prepare our trial balances. We have people that look over those to make sure that it is correct. And then we also comply with the laws and regulations. So we have to employ people or have a auditor outside of our company that will help us to comply with laws and regulations. All right, employee fraud is a serious problem for all businesses. It's something that every business should be aware of. And employee fraud is the intentional act of deceiving an employer for personal gain. The good news is that there are steps that we can take as our business to try to minimize the risk of employee fraud. All right, so going back to this employee fraud, some of the things that companies will do are background checks. They are also just talking about internal controls, talking about ethics, all these things say to our employees that this is important to us. And so that's some ways that we want to avoid employee fraud. The other thing that I want to tell you is that there's something called an employee or a fraud triangle. So we can look at it like this, and if you have all three pieces of the triangle, then that is the only way that you can have employee fraud. So let me tell you what those are. First of all, there has to be pressure. Your employee has to feel some sort of pressure. It can be real or just something that they perceive, but it has to be pressure. So we should actually call this perceived pressure. Perceived pressure is actually more true. All right, so for example, they could have an addiction that makes them need more money. They could have or gambling addiction or a substance abuse addiction. They could have credit issues. Creditors are after them. But some sort of pressure is making them need to steal money or assets from the business. All right, and then they have to have opportunity. So opportunity means that they have to have a way to do it and get away with it. So there has to be an opportunity. And then the other one is rationalization. Somehow in their mind, they have to be able to rationalize it. There's several different ways they can do this. A lot of times they'll just say, I'm just borrowing it, I plan to pay it back. Or I work a lot more hours than everybody else, I deserve this. Or they don't pay me, or they don't appreciate me, so I deserve this. So if you as the business can take away one or more of these, then you can help to prevent employee fraud. Okay, now let's talk about the elements of internal control. The 3 internal control objectives can be achieved by applying the following 5 elements of internal control. So we need to assess the risk, and we need to have control procedures in place. We need to monitor it, and all the while, management needs to communicate the information for the business. The overall attitude of management and employees about the importance of controls is part of the control environment. 3 factors that influence a company's control environment are here. So you've got the organizational structure, the CEO and the employees, how open it is, how they communicate. You've got the personnel policies. One personnel policy that can help prevent fraud is mandating vacations so that nobody can stay and never take a vacation. Some people would be afraid to take a vacation because they'd be afraid that somebody would find their fraud. So mandating vacations can help. And then management's philosophy and operating style. So one thing that happened at WorldCom, they overstated their net income, was that it was an environment of cutthroat, competitive, always want to do better, without much regard to ethics. And so that management's philosophy style made it more likely that the people would feel the pressure to lie on the financial statements to get what was desired of them. So that's what we mean by this environment. So all businesses face risks such as changes in customer requirements, competitive threats, regulatory changes, and changes in economic factors. So if you think about Blockbuster, I don't know if you remember Blockbuster, the good old days when you actually went into a store and picked out, at first they were VHSs, and then later they did make the change that was necessary to go to DVDs. But then there was another customer requirement and another competitive threat that came about, and that was streaming. And Blockbuster didn't keep up with that, and that became a business risk of theirs, and they eventually went bankrupt. So management should identify such risks, analyze their significance, assess the likelihood of them occurring, and take any actions needed to minimize them. Because when you're operating in a risky environment, like you're having trouble making profits or you're having trouble with this, then that increases the risk of fraud. So, for example, what happened to WorldCom was that they started losing money because of shifts in technologies, and that was a risk that they weren't aware of. And then to make up for that, some fraud happened. So, and that's very much simplifying it, but that's just an example of why risk assessment is so important. All right, so our control procedures should provide reasonable assurance that the business goals will be achieved, including the prevention of fraud. The 5 control procedures are depicted below. So we've got competent personnel. So our people need to have the right education, the right experience, and we need to also support them getting continuing education to stay up to date and stay competent. Rotating duties and mandatory vacations. Again, this is so that they can't be covering up any fraud that they may be doing. Separating responsibilities for related operations. Separating operations for custody of assets and accounting. And then doing proofs and security measures. So we're going to learn one real important proof, which is our bank statement reconciliation. Monitoring is important. So it's going to help us to locate weaknesses and improve control. So once we set it up, we need to make sure that we monitor it. Observe the employee's behavior. Make sure that they are doing everything that we've set them up to do for these internal controls. And look at the accounting system for indicators of control problems. So some warning signs of control problems. If you have an employee with an abrupt change in lifestyle and they didn't win the lottery, then it could be a warning sign. Now, of course, they could have inherited some money or they could have gotten a second job or something else, but it's just one of those warning signs that you want to look into. If an employee has a close relationship with suppliers, you don't want them to collude with the supplier and steal money from you in that way. If they refuse to take a vacation, if they have frequent borrowing from other employees, because if they need to borrow money, that's just showing that there's a pressure there, and excessive use of alcohol or drugs, which could also create that pressure that we talked about. So again, this doesn't mean for sure that they are stealing, but these are warning signs that you want to look into. So warning signs for the accounting system would be if you have missing documents or gaps in transaction numbers. It could mean that a document was used for fraudulent purposes. In other words, you made up a dummy invoice that wasn't actually there, or you threw away an invoice. You gave a copy to the customer, pocketed their money, and then threw away the invoice so that it wouldn't get put into your system. Any unusual increase in customer refunds, the refunds may be phony. A difference in daily cash receipts and bank deposits could mean that the receipts are being pocketed before they're being deposited. Sudden increase in slow payments, the employee may be pocketing the payments. And a backlog in recording transactions, maybe they're trying to delay the detection of that fraud. Information about the control environment, risk assessment, control procedures, and monitoring is used by management for guiding operations and ensuring compliance with reporting, legal, and regulatory requirements. Management also uses external information to assess events and conditions that impact decision-making and external reporting. So management needs to look at everything that's happening inside the company and outside the company. Okay, so now we're going to apply the definitions and determine if each of these would relate to the control environment, the risk assessment, or the control procedures. So mandatory vacations is a procedure that we put into place, so control procedures. Personnel policies is how we set out that environment, so that's control environment. And if a report of outside consultants on future market changes is a risk assessment. There are some limitations of internal control. So even if we have perfect internal controls, there are going to be some limitations. So first of all, collusion can happen when 2 or more people work together to circumvent the internal controls and defraud a company. And the stricter the internal controls, the higher the cost. It's going to cost more to have great internal controls. So you've got to look at the cost versus benefit of these internal controls. All right, let's talk about cash. Cash is one of the important things for a company to safeguard because it's one of the most easily stolen assets. Cash includes coins, currency, paper money, checks, and money orders. Money on deposit with a bank or other financial institution that is available. In other words, money that you deposit to your bank. And cash is the most likely item to be stolen or used improperly in a business. To protect cash from theft and misuse, a business must control cash from the time it is received all the way until the time it is deposited into the bank. Businesses normally receive cash from 2 main sources: Customers purchasing product or services give you cash, and then customers that are making payments on account for something that they bought before but they owe you. An important control to protect cash received is the over-the-counter sales is the cash register. So we've all seen these, some of you guys have worked with them, but the cash goes into it and it makes a record for us. And the records go to the accounting department that then makes a journal entry. And then the cash from the cash register goes to the cashier's department, and then they make a deposit slip out, and then it goes to the bank. So salespersons can make errors in making change for customers and ringing up cash sales. So there are usually some small differences in the amount that the cash register says we have and then the amount that we count out of our cash register drawer. And we call this cash short over account. So sometimes you're short, sometimes you're over. For example, the cash register total for sales from May 3rd totaled $35,690. However, cash receipts from cash sales said that we should have had $35,668. The cash sales receipt and shortage would be recorded as follows. So we're going to put the cash in that we really have. So the cash receipts that we really have is $35,668. We're going to also record the sales that we say we really have. We said we have sales of $35,690, but there's a difference. So we're going to put the difference to cash short and over. And you put it on the side that you need to balance. So in this case, we needed more debit, so we put it in on the debit side. So it turns out if there's a cash shortage, then you're going to need a debit to the cash short and over. And if there's a cash overage, then you're going to need a credit for the cash short and over. So on the income statement at the end of the accounting period, a debit balance in the cash short and over is included in miscellaneous expense. So that's where you're going to report that. And if you had a credit balance in it, then you're going to report that in the other revenue section. All right, for cash received in the mail, it would come to us in the mail, and most companies design an invoice so the customers return a portion of the invoice called a remittance advice with their payment, and this document can be used to control cash received in the mail. The other way that you can receive it is through an EFT, electronic funds transfer. So a customer may authorize automatic electronic transfers from their checking accounts to pay monthly bills for items such as a cell phone, internet, and electric services. Companies encourage customers to use this because it costs less than receiving cash payments through the mail because it's done automatically, so they don't have to pay an employee to do this. And it also enhances their internal controls because it's received directly by the bank, so it doesn't go through any employees to get to the bank. And it reduces late payments because it's automatically withdrawn from the customer, so customers don't forget as much, and it also speeds up the processing of cash receipts. The control of cash payments should provide reasonable assurance that payments are made only for authorized transactions and that cash is used effectively and efficiently. For example, controls should ensure that all available purchase discounts are taken. So we wouldn't want to leave any discounts on the table because that's making us pay more money than what we should have. A voucher system is a set of procedures for authorizing and recording liabilities and cash payments. It may either be manual or computerized. A voucher is any document that serves as proof of authority to pay cash or issue an electronic funds transfer. If you worked for the state or a large company, you've probably used the voucher system. So for the purchase of goods, a voucher is supported by the supplier's invoice, a purchase order, and a receiving report. So businesses use bank accounts mostly for internal control. And so some control advantages of using bank accounts is that it reduces the amount of cash on hand, and it provides an independent recording of cash transactions, and allows us to reconcile what we say we have to what the bank says. And it also facilitates the transfer of funds using EFT systems. So it wouldn't be safe to keep all the cash on the business premises, so we put it in the bank to safeguard it. The bank statement maintains a record of all checking account transactions. A summary of all the transactions, called a bank statement, is mailed usually each month to the company or made available online. A bank statement shows the beginning balance, additions, deductions, and the ending balance. So this is an example of a bank statement. And so it goes from the period of 6/30/2018 to 7/31/2018. It tells us that we had 22 deposits, and it's going to list those out, and 52, I need some glasses, withdrawals. And then it tells you your new ending balance. So what we would do is we would compare this to our cash account. And when we say our cash account, we mean our general ledger account. We'd look at all of our debits, all of our credits, and we would make sure that they are the same on the bank statement. And any differences that we find will go on to our bank statement reconciliation. So we're going to call this the book side. That's our cash account. And we're going to call what the bank has the bank side when we go to do our reconciliation. All right, the company's checking account balance in the bank records is a liability. Thus, in the bank records, the company's account has a credit balance. So what I'm saying here is that our cash account for us is an asset. But this same account, from the bank's perspective, anytime we deposit money into it, they owe it to us because it belongs to us. So from the bank's perspective, our cash is a liability. And so every time it increases, they credit our account. And that's why you'll hear people talk about they credited my account as being a good thing. So that's because that means that they increased it from their perspective. But of course, from our perspective, if we want to increase our cash, we debit it. That's why a person that works for a bank thinks completely opposite as a person that works for a company, because the bank is on the opposite side of this. All right, so here it is. Our cash is an asset, and our cash at the bank from the bank's perspective is a liability. So when they increase our liability, they call it a credit memo. So when a customer deposits money straight to our account, it's called a credit memo. EFT deposits, note receivable collection, loan proceeds, interest earned, a bank error that gives us money back, all those are called credit memo. When they take money away from us, like in service charges, NSF checks, bank errors, EFT payments, they call it a debit memo. And that's because it's coming from the bank's perspective. Instances where a bank makes credit entries. So when they issue a credit memo, these are some examples of when they would do that. If there's a deposit made by a customer by EFT, this would be a credit entry. It would increase our account. If they collect a note on our behalf, then this would be a credit entry. Proceeds for a loan made to the company by the bank. So if we borrow money from the bank, that means the bank's going to put money into our account because we borrowed it. That's a credit memo. If we earn interest on our balance, credit memo. And if there's any kind of correction where they needed to put money back into our account because they took out the wrong amount, that would be a credit memo as well. So these are the instances where they would actually make debit memos, where they would take money out of our account. If we made a payment, so like the business paid a utility bill, if they charged us a service charge, if a customer's check was returned for non-sufficient funds, so a customer wrote us a bad check, we deposited it, the bank gave us their money, and then after a day or so they found out that that check was no good, they would withdraw that money back away from us. And if there was any correction where they needed to deduct money from our bank account. So these are some of the abbreviations that we may see for some of these items. EC could stand for error correction. NSF, non-sufficient funds, that means a bad check. Service charge, SC. ACH, automatic clearinghouse for electronic funds transfer. And MS would be miscellaneous items, such as a collection of note receivable on behalf of the company. All right, let's practice this for just a bit. The following items may appear on a bank statement. Number 1, non-sufficient funds. So where would we find that? So non-sufficient funds would be a subtraction. They would take it back away from us, and it would be, therefore, on the bank statement as a debit memo. So number 1, debit memo. And it would decrease our account. All right, number 2, EFT deposit. All right, so that would be a credit memo because that would make our account go up. So that would increase. And number 3, service charge. They're going to take that money out of our account, and so that's going to be a debit memo. They'll take that money out, so they're going to decrease our account for that. And then number 4, bank correction of an error from recording a $400 check issued by the company as $40. So we wrote a check for $400. That's how much we wrote our check for. We said pay to the order, pay $400. But the bank only took out $40 from our account. So in order to correct this, they need to take out more money. Actually, they need to take out 400 minus 40. So they need to take out $360 more dollars. So number 4 is going to be a debit memo. They're going to take that money back out. And so it's going to decrease our account because they didn't take out enough money for that check that we wrote to somebody. All right, so let's check our work. Debit, credit, debit, debit. Every single time you see a debit, it decreased. Every time you see a credit, it increased. And again, that's because that's from the bank's perspective. All right, so the cash balance shown by the bank is usually different from the company's cash balance, and that is because of timing differences. Number 1, a delay by either the company or the bank in recording transactions, like a check that's still outstanding, or the bank has debited or credited our company account and we didn't know about it, or we haven't made the journal entry for it yet, so we need to update our records, or if there are any errors. So for those reasons, the bank account balance on the bank statement usually will not exactly match our cash account, and that's why we have to do a reconciliation of those two items. So here we have a bank statement, and our ending balance is $3,359, but our ending balance on our general ledger in our business is $2,549.99. So we need to find out what the differences are, and that's going to be our reconciliation. We're going to find out what's different. So the bank reconciliation is when we analyze the items and amounts that made those two balances different. The adjusted cash balance determined on our bank reconciliation will be what we finally recognize on our balance sheet, because we're going to update our cash account to be the right amount when we get finished with this. So we're going to split it up into 2 sections. We're going to start with the bank balance, and then we're going to do the company balance. Sometimes you'll hear this as bank and book or bank and company, but those are the 2 sections that we're going to have, and at the end they need to be equal. So the bank section, we'll start with that one, is going to be the cash balance according to the bank, and then we'll add any debits to cash that aren't on the bank statement. They're usually deposits in transit. Then we will subtract out any credits to cash not on the bank statement. These are usually outstanding checks. And then any bank errors to get to our adjusted balance. For the company section, we're going to start with our company cash balance, that's our T account, and then we'll add anything that we haven't recorded that needs to be added, and we'll subtract anything that we haven't recorded that needs to be subtracted, and then we'll get to our adjusted balance. All right, you can read through these steps, but I think it's best if I just do an example for you. So you'll read through these steps, and when you're doing it for your first time through your homework, you can follow those steps, and they will get you to the right answer. All right, for me, I'm just going to show you how this works, and then they'll have some other videos where I work one as well for more practice. All right, so step 1, we're going to put down the balance according to the bank statement. So we're going to get this from the bank statement. Then we're going to find out that we had a deposit in transit. This means that the bank doesn't know about the deposit yet because we turned it in after hours and then they ran the bank statement that night. So it's a deposit that's in transit. It hasn't been cleared by the bank yet. So we add that there. Then we've got the same thing for outstanding checks. So these checks have not cleared the bank, so we need to subtract them out because we know that as soon as the bank gets them, they will be subtracted. And so this is our adjusted bank balance. Now we're going to start with the book side or the company side. So we have our cash balance according to our books, our company from our T account right here. And then the bank had collected a note for us and we haven't recorded it yet. So we need to go ahead and add it here. Then we had these items that subtracted from our bank account that we haven't recorded yet. So notice that everything on the company side is because we haven't recorded it yet and now we need to record it. Once we do that, we get to our adjusted balance and note that they are in balance, so now we are reconciled. So what we need to do now is update our records for the items that we had not yet recorded. We are good on this side. We don't make any entries. We already recorded that. The bank will update when they get those. We make our entries from the book side. So we will make journal entries here, adjusting journal entries to update our cash for these. All right, so these are the journal entries. We need to increase cash for the notes receivable and the interest revenue. And then we need to decrease cash for the non-sufficient fund that was returned, a miscellaneous expense, and an accounts payable that we just had an error on. So these journal entries came from, and they will always come from, the book side. Now I'm going to do a longer example that I'll walk you through when we do this. Right now, I just want you to see the overview, the general idea of a bank reconciliation. So what I want you to understand from this right now is that we have a bank side and a company side, and that we make journal entries after we finish from the company side. All right, so we can work this problem as an example. And so I want you to pause it, look at it, try to do it on your own, but then look at the answer and see if you got to the right answer. All right, next is petty cash fund. Here again, I'm going to work some specific examples. What I want to do with you in this PowerPoint is to give you a broad general idea of what is to come. So a petty cash fund is when a business keeps cash in their office or their work environment so that people can take it and buy small items. So they need to take the money out of the bank, put it into an envelope or a drawer, and then people can use it for business items, and this is how we're going to account for it. So first of all, we need to set up our petty cash fund. So we're going to take money out of our bank account and put it into dollars. Okay, and then we'll put that in an envelope or in a drawer on our business premises. So the only time that you debit petty cash right here is when we first set it up. After that, on the balance sheet, it is always going to look like we have, in this situation, $500. Okay, because the amount's considered immaterial, not big enough to worry about. So on our balance sheet, you're going to see petty cash $500. Now it does matter how we spend it, and we are going to categorize it according to where it's going, and I'll show you what I mean. So at the end of August, there's $30 left, so we've spent some. And people have to put in the receipts of what they spent it on. This is where our journal entries are going to come in. We're going to make journal entries for each of those expenditures. So in this case, we had some office supplies, some postage, some store supplies, some miscellaneous administrative expense. And so we will actually debit expense accounts for that amount. But here's the key. We don't do anything to petty cash. We're just going to take it out of the bank again to replenish our fund. So we're going to take it out of the bank, $470, and then we're going to show where it went in our accounts, and then we will put that $470 back into that envelope. We're calling it an envelope. It could be a drawer, but wherever they put that money to replenish it. So we had $30 in, and we replenished $470, so that got us back up to the $500, so we can start back over. All right, we also have special purpose funds. So cash funds are often used by companies for special needs like payroll or travel expenses. So they're established and controlled in a manner similar to that of a petty cash fund. All right, we report cash on the balance sheet because it's an asset, but other things are so close to cash that we call them cash equivalents. So if we have things that are very, very liquid, very easy to turn into cash, like U.S. Treasury bills or notes issued by major corporations, sometimes called commercial paper, or money market funds. It's just a different type of an account that we open up at a bank to maybe get a higher interest rate. They're so close to cash that we call them cash equivalents. So on the balance sheet, it's going to look like cash and cash equivalents. And this company has $235,000. So we always end with financial statement analysis. And so this chapter's financial statement analysis is the ratio of cash to monthly cash expenses. So startup companies or companies that are in financial trouble often report losses and negative cash flow from operations. The ratio of cash to monthly cash expenses is useful for assessing how long a company can continue without additional financing or generating positive cash flows. So this is a ratio that can help, especially if you have a company in trouble. So the numerator is cash as of the year end, so the ending cash, divided by the monthly cash expenses. So the monthly cash expenses, so remember, cash includes any cash equivalents, and you can get that from the balance sheet at the year end. The monthly cash expenses, sometimes called cash burn, are estimated from the operating activity section of the statement of cash flows. So you would look at the negative cash flow from operations, that's your operating cash flows, and then divide it by 12. And that will give you your estimated monthly, because there's 12 months in a year. So it's going to look like this. We've got cash on December 31st of $102,000, cash flow from operations negative $144,000. So we will say negative cash flow from operations is that 144 divided by 12, and that's going to give you your monthly cash expenses. And then cash at the year end, that's your $102,000, and then divided by your denominator, and that gives you 8.5 months. So what that says is that we've got 8.5 months of cash remaining as of December 31st. That's just an average, but it tells us we can continue operations about 8.5 months. So you can see how that would be a helpful ratio to use. So that concludes this PowerPoint. Let me know if you have any questions. Thanks.